In this video, we're going to be performing a deep dive on Altria's dividend safety. To begin, let's talk about Altria's business model. Altria is a cigarette company that sells the Marlboro brand of cigarettes in the United States, as well as a number of non-smokable brands, including Skoal, Copenhagen, and the St. Michel brand of wine. Altria also has a 10% ownership stake in global alcoholic beverage manufacturer Anheuser-Busch InBev. For many years, Altria has been one of the world's most well-known blue-chip stocks because of its remarkable performance. The company has been one of the best-performing stocks over the last 5 decades. Altria is also popular among income investors because of its exceptionally high dividend yield. The company trades with a yield above 5% today. Looking ahead, Altria's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss Altria's dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Altria's dividend safety in the context of the company's current earnings. When Altria executives presented at the Barclays Global Consumer Staples Conference on September 5th, the company reaffirmed its financial guidance for fiscal 2018. Altria continues to expect to generate full-year adjusted earnings per share between $3.94 and $4.03. For context, Altria currently pays an annualized dividend of $3.20 per share. This implies a dividend payout ratio of 80% using the midpoint of the company's 2018 earnings guidance. Using earnings, Altria's dividend is very safe and we have no concerns with its sustainability moving forward. Many analysts believe that comparing a company's dividend payments to free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Altria's current dividend payment to its free cash flow. In fiscal 2017, Altria generated $4.922 billion of cash from operating activities and spent just $199 million on capital expenditures. This implies full-year free cash flow of $4.723 billion. For context, Altria paid $4.807 billion in common share dividends during the same time period. Using free cash flow, Altria's dividend payout ratio was actually above 100% in fiscal 2017. Investors should closely monitor this moving forward, as this is unsustainable over long periods of time. Fortunately, the situation has improved significantly lately. Through the 6-month period ending June 30th, 2018, Altria generated free cash flow of $3.778 billion and spent $2.585 billion on common share dividends for a free cash flow payout ratio of 68%. We believe that 2017's high free cash flow payout ratio was an anomaly, and that overall, Altria's dividend is safe when measured by free cash flow. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Altria's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Altria's performance during this time period is shown here. As you can see, Altria's earnings per share rose each year of the financial crisis. This is due to the cheap pricing of their products as well as their addictive characteristics. Accordingly, we have no concerns about the company's ability to pay rising dividends through future economic downturns. The last angle that we will use to assess Altria's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before Altria's free cash flow will no longer cover its dividend payment. At the end of the most recent reporting period, Altria had exactly $14 billion of debt outstanding. Through the first 6 months of fiscal 2018, the company generated $344 million of interest expense, which implies a weighted average interest rate of 4.9%. The following image shows how changes to Altria's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Altria's weighted average interest rate would need to rise above the 20% level before its dividend would no longer be covered by free cash flow. Accordingly, our opinion remains unchanged. Altria's dividend appears to be very safe for the foreseeable future. Thank you for watching today's video, which performed a deep dive on Altria's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.